Cross-hedging trading strategy. Cross-hedging is a strategy used to manage risk by hedging a position in one asset with a position in a different, but related, asset. Cross-hedging works by leveraging the correlation between two assets. By taking a position in a related asset, traders can offset the risk of adverse price movements in the underlying asset. Unlike traditional hedging, which involves hedging a position with the same asset or a very similar one, cross-hedging seeks to find correlations between different assets to mitigate risk. The primary purpose of cross-hedging is to manage risk by using a related, but different, asset to offset potential losses in the underlying asset. Cross-hedging works by leveraging the correlation between two assets. By taking a position in a related asset, traders can offset the risk of adverse price movements in the underlying asset. Cross-hedging cannot eliminate all risks, but it can significantly reduce exposure to certain market risks. Financial derivatives such as options, futures, and swaps, along with statistical and technical analysis tools, are commonly used in cross-hedging. While traditional hedging involves using a direct and perfectly correlated instrument, cross-hedging uses a related but not perfectly correlated one. This approach is often necessary in markets where perfect hedges are not available or are too expensive. Key concepts in cross-hedging. 1. Correlation. The degree to which two assets move in relation to each other. 2. Basis risk. The risk that the hedge will not move perfectly inversely to the position it is meant to hedge. 3. Hedge ratio. The ratio of the size of the position taken in the hedging instrument to the size of the position being hedged. Advantages and disadvantages of cross-hedging. Some advantages to cross-hedging are: 1. Flexibility. Allows hedging when direct hedging instruments are unavailable. 2. Cost-effective. Often cheaper than finding a perfect hedge. 3. Risk diversification. Diversifies risk across different but related markets. The disadvantages to cross-hedging are: 1. Basis risk. Imperfect correlation can lead to less effective hedging. 2. Complexity. Requires a deep understanding of different markets and their correlations. 3. Potential mismatches. Differences in liquidity and volatility can impact the hedge's effectiveness. Some common instruments used in cross-hedging are: 1. Futures contracts. Agreements to buy or sell an asset at a future date for a fixed price. 2. Options. Contracts that give the holder the right, but not the obligation, to buy or sell an asset at a predetermined price. 3. Swaps. Contracts to exchange cash flows or other financial instruments. The hedge ratio is crucial for effective cross-hedging. It can be calculated using the formula: hedge ratio equals value of hedging instrument divided by the value of position being hedged. This ensures that the hedging position appropriately offsets the risk exposure. Just a quick reminder to please hit the like button and subscribe to the channel for more great content like this. Also, visit us on the web at www.investmentees.com and use code BLOG to receive 25% on your next purchase. To start with cross-hedging, traders should identify the risk to be hedged, select the right instruments, determine the hedging ratio, execute the hedge, and continuously monitor and adjust their positions. 1. Identify the risk. Understand the specific risk that needs to be hedged. 2. Select the hedging instrument. Choose a correlated asset or derivative. 3. Determine the hedging ratio. Calculate the appropriate ratio to hedge the risk effectively. 4. Execute the hedge. Implement the hedging strategy. 5. Monitor and adjust. Continuously monitor the hedge and make adjustments as needed. Selecting the right instruments for cross-hedging is critical. Traders must consider factors such as correlation, liquidity, and cost when choosing hedging instruments. Commonly used instruments include futures, options, and ETFs. Cross-hedging in different markets. Equity markets. Cross-hedging can be used in equity markets by taking positions in related stocks or indices. For example, an investor might hedge a position in a technology stock with a position in a technology ETF. Commodity markets. Commodity traders frequently use cross-hedging to manage price risks. For instance, a trader in the coffee market might use cocoa futures to hedge if the two commodities are correlated. Forex markets. In the forex market, cross-hedging can be particularly useful due to the complex relationships between different currencies. Traders might hedge a position in one currency by taking an offsetting position in another closely related currency. Examples of cross-hedging. Agricultural commodities. Farmers often use cross-hedging to protect against price volatility in agricultural markets. For example, a soybean farmer might hedge with corn futures if the prices of these commodities are closely correlated. Energy markets. In energy markets, companies might use cross-hedging to manage risks associated with oil and natural gas prices. For instance, a company exposed to crude oil prices might hedge with natural gas futures if the two prices are related. Currency markets. In the forex market, traders often use cross-hedging to manage currency risk. For example, a business with exposure to the euro might hedge using the British pound if there is a strong correlation between the two currencies. Cross-hedging strategies. Pair trading. Pair trading involves taking offsetting positions in two correlated assets. This strategy aims to profit from the relative price movement between the two assets rather than their absolute price movements. Spread trading. Spread trading involves buying one asset and selling another related asset. This strategy is commonly used in commodity and futures markets to take advantage of price differentials between related assets. Arbitrage opportunities. Arbitrage involves taking advantage of price discrepancies between different markets or assets. Cross-hedging can create arbitrage opportunities by exploiting mispricings between correlated assets. Conclusion. Cross-hedging is a valuable risk management strategy that involves taking an offsetting position in a related asset. It offers benefits such as risk management, cost efficiency, and flexibility, but also comes with risks like basis risk, liquidity risk, and market risk. It provides traders with a powerful tool to manage risk in various markets. By understanding the relationships between different assets and implementing effective strategies, traders can protect their investments and improve their portfolio performance. Thank you for watching.